Welcome to the NISM Masterclass. I'm your host, Sashi Krishnan. Our purpose at NISM is capacity building for the securities market ecosystem. And as part of that purpose, we sit down with the thought leaders in the financial services business and in the financial ecosystem to understand and learn from their journey. And my guest today is Shri K. Rajaraman. And Shri Rajaraman is the current chairperson of the International Financial Services Centers Authority, IFSCA in short. And he has been the chairman since 2023. Mr. Rajaraman is a 1989 batch Indian Administrative Services officer who previously served as the secretary in the Department of Telecommunications. And he's also held very, very senior positions in the Ministry of Finance, including the additional secretary investments in the Department of Economic Affairs and many more such positions. So welcome to this masterclass, sir. And thank you so much for sparing time. I want to begin with a very basic question in terms of what are the advantages of setting up an international financial services center in any country, especially in India. And from a strategic perspective, how important is it for India to onshore financial transactions that would otherwise have taken place in global hubs like, London or Singapore and so on?
So thank you, Mr. Krishnan. I think, first of all, I must congratulate you and NISM for the strides you have made in actually expanding the number of offerings for the capital markets. Because I always strongly have believed that capacity building is the way in which I think any system evolves.
Yes.
And more so in a complicated ecosystem like capital markets. Creating the right kind of education and capacities within both the private sector and in the government sector is very key to actually ensuring that the systems function as intended. So from that perspective, NISM has done extremely well, and we are also happy that IFSC has signed an MOU with NISM as well.
Right, sir. Thank you so much.
And coming back to your question, I think this is a very fundamental question which has actually driven the conceptualization and the establishment of the IFSCA. As you rightly observed, I think there are very many activities which could have been done in India, which migrated outside the country to various other preferred destinations, like London, Singapore, Dubai, etc., because of various factors. So some of the key factors that led to such businesses migrating outside over the last several decades, it's not yesterday or today. So it is all long years, for the last 40, 50 years. So the reasons are not hard to seek. I think some of the usual reasons like an enabling tax regime which is competitive, then enabling regulatory environment with ease of doing business, and other things like say availability of finance, availability of talented people. So there are a whole host of things which businesses have often taken into account while deciding to set up businesses abroad. So the fact that Indian businesses are going abroad is per se not wrong. It is a good thing.
Okay.
But the fact was that I think there are some of these businesses were doing India business sitting in those jurisdictions.
Right.
So typically like a shipless, or I think leasing ships out of other like destinations like Dubai, Hong Kong, etc., and leasing ships into India. So, or a fund which is set up in Mauritius or Cayman Islands, but pooling money from NRI investors and investing into India. So these pretty well could have been done within India because these are all fundamentally India-focused investments. So several years ago, when the Honorable Prime Minister was visiting some of these business centers, he hit upon the idea of setting up a financial center of class and scale, which meets with some of these competitors in global jurisdictions. Okay. So the idea was actually to start with of onshoring the offshore. So many of the offshore units of Indian businesses, how do we bring them back onshore? So that led to the thinking that that if at all we get to create such a ecosystem, then it must solve the problems that the businesses had faced before deciding to go out.
Right.
So these 4 or 5 issues which I just mentioned had to be solved for in this jurisdiction before we created. So the thought process and the concept of IFSC includes an enabling tax environment, an enabling regulatory environment which is aligned with the rest of the world.
Right.
And also built-in features of ease of doing business and providing high quality of living and so on and so forth.
Right. So, if I may just continue on that particular thread, the major benefits that any business would get by locating themselves in an international financial center like Gift City would be, among others, unified regulation, the tax holidays, the lower operating costs. So these make a very big difference to these businesses and the investors.
Yes, obviously. So, like for instance, many of the competitive jurisdictions across the world, they offer zero corporate tax for businesses,
Right.
and many of them also offer zero personal income tax,
Right.
and a whole host of other incentives.
Correct.
In addition to that, their regulations are typically the best in class, light touch, principle based, and more focused on and providing facilitation and support. So our focus is actually to create such a jurisdiction. So while the initial processes of IFSCA got started in 2014, when certain enabling regulations were issued by RBI and SEBI.
Right.
The real thrust came in 2019 when the Parliament enacted the International Financial Services Centers Authority Act,
Right.
which created a legal jurisdiction in the Gift City, with an authority to regulate this market. So this IFSCA Authority Act, while creating the authority, also empowered the authority with making regulations for under 16 Indian financial sector laws, which include the Insurance Act, the Banking Regulation Act, Securities Contract Regulation Act, the Insurance Act, the Pensions Act, then the Payments and Settlements Act, and so on. So IFSCA got on with the job from 2020 when it became operational. Thereafter, I think the nearly 35 regulations were notified. And these regulations, to answer your question, were completely benchmarked with what obtained in other jurisdictions. So the idea was to attract the businesses to come here. And the comfort zone would exist when these regulations and the global regulations are aligned, more or less.
Right.
So that is what we have achieved to a large extent. As regards other enabling factors, let me say that the Indian ecosystem already enjoys a high standard in terms of the quality of human resources.
Right.
I mean, there are no, India is dependent.
There's no dearth of talent.
Yes, absolutely. And India is today the global capability center of the world.
Right.
So, I mean, all the large companies in the world rely on India for that. So, on human resources front, we wouldn't have a challenge as yet. And on another front as well, India enjoys a lot of capability is the cost of living.
Right.
We are one of the most affordable countries in the world with a high affordability. So therefore, the talent could be hired at a very affordable cost. The costs of operation are also low in terms of the lower costs of real estate and so on and so forth. So we have certain natural advantages combined along with tax advantages and regulatory advantages. I think this can be turned into a real opportunity for India.
So I had two questions on what you just said. One is that how do we actually compared to other jurisdictions? So you said ease of doing business. How do we compare, like in terms of ease of doing business with, say, Singapore or Dubai or Hong Kong, in Asia at least? Talent, you said we have sufficient talent out here, but how do we compare with these other jurisdictions?
So, just to go back to the answer I gave you just a while ago, the focus of our regulation making was on how do we compare with the rest of the world.
Correct.
So all the teams here which were part of the drafting the initial set of regulations, the 35 regulations which have been notified till date, have necessarily benchmarking with global jurisdictions as a first part of the exercise in making regulations.
Right.
So, while the banking regulations were made, we looked at what is the regulations in Hong Kong, London, Singapore, etc.
Right.
And the idea was to actually align us as far as possible with those regulations, subject to the limitation of our own laws. Because obviously these regulations are made under Indian laws.
Right. Exactly.
So therefore, to that extent, I think we have largely achieved our task.
Okay.
And I would say that the answer to that question is in the outcomes. So the proof of the pudding is in the eating.
Right.
Finally. So therefore, in the last 5 years since 2020, when we got started, we have managed to attract a large number of banks, which are very strong international, global, systematically important banks. There are 38 banks here. Assets under management is a little over $100 billion.
Okay.
The total amount of money lent so far to Indian and foreign corporates has crossed $78 billion. So the banking system is very strong. Similarly, is the case with the fund industry. We have a very competitive fund management entity regulations, which actually compare with the rest of the world. Again, the same process was adopted. We looked at what Singapore did, what Mauritius was doing, many other fund jurisdictions like London and New York, etc. I mean, all these regulations were compared And then we looked at all those matters of ease of doing business in terms of principles that were deployed, etc., and ensured that our regulations are the best in class. So, as a consequence, today, in the last 5 years, today we have 200 fund managers who are now registered with us. And these 200 fund managers in turn have registered about 330 funds, alternate investment funds, all kinds of funds, venture capital funds, angel funds, impact funds, hedge funds, private equity, private debt funds, all kinds of funds have been registered here. And not only that, I think very recently, nearly about 10 retail funds also have been registered here to cater to the large diaspora who live across the world. I think the 34 million non-resident Indians and persons of Indian origin who have interest in India.
So the second question I had on this is that you are a unified regulator. So do the other jurisdictions also have this unified regulator, or is that something that you've actually sort of pioneered? Because I do understand that many other jurisdictions have fragmented regulations.
So, there are this taxonomy is of various kinds.
Right.
So, if you go to a small country like Singapore, you have a unified regulator,
right,
the Monetary Authority of Singapore. So, when you go to a large country,
when you go to London, for example, you have
multiple regulators. You have the FCA, the PRA, the Bank of England, and so on and so forth. So, I think we have converted the opportunity into an advantage. Like, for instance, we have a small jurisdiction, the GIFT City.
Right.
So, therefore, from that perspective, I think it would be viable to have a small unified regulator. Okay. So, from that perspective, and not only that, the architecture of the IFSCA Act, which was enacted by Parliament, and the intention of the Government of India, which is embedded therein, shows very clearly, I think, the idea behind unification of the regulations as a means of creating more innovation and ensuring that things don't fall between the stools is also part of the design, I think. Right. So, therefore, I think I would say that the advantage of being a unified regulator is that it makes things simpler for businesses. Right. Because they don't, because typically when a financial sector business is set up, they would do a variety of businesses, I think. So, for example, a bank here would want to become a corporate agent under the Insurance Act to sell insurance products. A bank may also want to become an investment advisor under the capital markets regulations. Right. So, being a unified regulator enables us to create regulations which actually may enable businesses to scale up meaningfully and provide wholesome solutions to the market, to the customers. Right. So, from that perspective, I think the fact that we are a unified regulator has made a lot of as advantages. So, let me give an example. I think even from a regulatory perspective, it helps us to actually create a harmonized regulatory environment, because often what happens is that when you have multiple regulators, you have the problem of the regulations evolving in a different trajectory. Okay. Obviously, the markets are different, but the markets are also connected. From that point of view, I think the availability of ability to harmonize the regulations between various verticals is also important. So, let me give an example, I think. So, for example, the KYC problem. I think KYC is a problem in the capital markets, because they need to prove KYC.
Financial markets as a whole.
Yeah, exactly. So, for example, in the domestic area, SEBI has created a structure called the KRA. Okay. So, I think whereas in the banks depend upon a structure called the CKYC, which is run by SEBI. Right. So, the insurance industry also depends upon one or two of these entities. So, here we had the opportunity. So, therefore, we created a unified KRA framework. So, this KRA will serve all the industries. It will serve the banks, the insurance companies, the capital markets, the pension, and all the other kinds of markets where there is account-based relationship. Right. And from a unification perspective, it also enables customers to understand this far better than when it is a dispersed environment where there are multiple.
And they need to only do it once. Yes. They don't have to do it multiple times, one for a bank, one for the, your demat account like you have in the normal market.
Absolutely. So, then finally, I think it also enables a very coordinated product development. So, from like for instance, let me tell you that pension products often fall between insurance and pension. Right. Like for instance, things like a ULIP. Right. Things like money back policy, etc. I think there is treatment both under the Insurance Act as well as under the pension regulations. Right. So, from that perspective, I think being a unified regulator affords us to create products which are wholesome and which factor into account the requirements under various laws. So, from that perspective, from all these perspectives, I believe that IFSCA has the has seen the advantages of unification.
Unification.
Yes.
Mr. Rajaraman, in the recent Global Financial Centers Index, GIFT City is now ranked 43rd. And now it is ahead of Bombay and Delhi. And, it has moved up 30 places, I think, since 2021. It was 76 in 2021. Now it's moved to 43. So what are the key catalysts for this? I mean, how has this happened? It would be interesting to understand that.
So I would like to say that the IFSCA story is fundamentally part and parcel of the India growth story,
Right.
because IFSCA does not exist as a separate jurisdiction.
Right.
So it is attached to India as a means and as an instrument for India's growth and acceleration towards Viksit Bharat at 2047.
Right.
So from that perspective, I would say that the Indian growth story, the last 10 years has been phenomenal.
Okay.
If you look at the macroeconomic situation compared to from 2014 to say 2025, there has been significant scale up in terms of all the parameters. If you look at our financial sector, all the financial sector institutions have become healthy, very healthy.
Right.
I mean, in 2014, the percentage of bad loans on the books of banks in India was about 13%. Today, it is about under 3%.
Right.
The capital market has unleashed, the capital market regulator has unleashed a lot of reforms,
Right.
especially in the retail segment.
Right.
So as a consequence, in 2014, there were only 20 million unique trading accounts. Today, there are more than 135 million trading accounts in the stock market,
Correct.
unique accounts.
Right.
So which means that the reforms pace in domestic India has actually inspired global investors to come in, domestic investors to scale up investment, retail investors to participate in the markets. So the nature of the market itself has undergone significant shifts and changes. And we believe that the next 25 years is going to be very, very, very important from India, because all these economic forces have actually now accelerating. I would say that. Because let me also talk about one particular reform which is very fundamental in nature. While in reforms like GST, IBC, etc., have actually enabled this growth so far.
Right.
Going forward, the financial inclusion reforms which have been implemented in the last 7 years
Right.
are going to be very critical,
Okay.
because 540 million people who did not have bank accounts today have bank accounts. They have an Aadhaar,
Right.
they have a mobile phone number. So this digital infrastructure and the bottom of the pyramid, they are going to drive the next 25 years.
Right.
So you will see that the number of people who participate in the domestic Indian stock market is going to scale up like no time before.
Right.
So when all this is happening, I think the GIFT City has got very exciting opportunities, because the government of India has unveiled a number of very ambitious programs, which in the manufacturing sector, in the infrastructure sector, technologies development, and so on and so forth. So this requires tremendous amounts of capital.
Capital. Yes.
While the domestic economy will churn out capital, capital generation will happen from within the economy itself. But for the accelerated pace of development, we will require large amounts of foreign investment as well,
Correct.
both debt as equity as well.
Right.
So which means that I think the opportunity in GIFT City has actually multifold in the last 10 years. The world looks to GIFT City through the India lens. So therefore, from that perspective, I think the attractiveness of GIFT City as a platform to invest in India has actually taken us into places. I must also record the work of the government of India in this. The Honorable Prime Minister, the Honorable Finance Minister, they have taken a lot of pains in ensuring that the very attractive tax policy, an attractive enabling legal framework, all this have been put in place, which enables GIFT City to raise the trust and confidence among foreign investors, enabling them to invest into India using GIFT City as a platform.
Right.
So from that perspective, I would say that the ranking of GIFT City in the international global financial centers index is just a consequence of all these.
Correct. So, talking about this framework, I just want to also understand that the integration of IFSC into the Foreign Exchange Management Act, FEMA, is also, I think, a very key advantage for businesses, right? So, what are the advantages for exporters, say, operating through the IFSC banking units, the IBUs, especially for managing their foreign exchange exposure, in simplifying documentation, in reducing transaction costs? That must have been also a big enabler, right?
So, the domestic regulators have played a very important role in the development of IFSCA.
Right.
So, I always tell this to people who ask this question as to how is IFSCA managed. IFSC authority is composed of all the domestic sector regulators and the government of India. So, I mean, I am the chair of the board. Along with us, we have an executive director from RBI and another executive director from SEBI. We have a whole-time member from IRDA, an ED from PFRDA.
Right.
2 joint secretaries from the Government of India and the Department of Financial Services and Economic Affairs. So, this is a collectively managed platform for India's benefit and for the benefit of businesses, whether it is Indian or foreign. So, I would credit a lot of work done by Reserve Bank of India and the SEBI in this matter. So, RBI has provided a very sound set of enabling regulations for under FEMA for both trade credit, for external commercial borrowings, and for certain businesses like Bullion and so on and so forth. So, all these enabling regulations have helped the businesses to onshore themselves here and do international as well as national businesses sitting out of GIFT City. So, if you are talking specifically about exporters, India, I mean, IFSC's mandate has always been to support the Government of India in all its flagship programs. One of the flagship initiatives of the Government of India is to enable Indian exporters to conquer the world markets. So, the Honorable Minister for Commerce and Industry has announced that the Indian exports need to scale up to nearly $2 trillion from the current $825 to $850 billion to $2 trillion by about 2030. So, this one of the very important inputs to exports is availability of trade finance. So, the GIFT City fulfills a very important gap by enabling trade finance, access to trade finance for Indian exporters to do exports as well as imports. So, the banking system in GIFT City, for instance, out of the total $78 billion of trade credit, which has been extended by them, nearly $15 billion outstanding is on trade finance. So, this has been provided to various corporates in India. IFSCA is also enabled through a framework setting up of TREDS-like platforms here. In domestic India, you have TREDS. It's actually where exporters can actually factor their bills receivables, and then raise money in advance, before they actually get the payouts from their buyers. So, the platforms here are called ITFS, International Trade Financing Platforms. So, these platforms have supported nearly about $80 million of trades receivables for the Indian exporter by enabling them to auction their bills receivables. So, this platforms, I mean, in addition to these platforms, I think we also have a finance company regulation. Under the finance company regulations, we have enabled setting up of factors, global factoring companies, which actually are do the same thing of buying the bills receivables and then, I mean, extending loans to this exporter or the importer, as the case may be. So, in all this, I think the RBI has played a very important role. I think, in fact, recently the RBI issued a mandate saying that exporters can hold their export receivables in foreign destinations. If it is a foreign destination, they have allowed the exporter to hold it for 1 month. Whereas in GIFT City, if an exporter can hold it for 3 months. So, therefore, from all this perspective, GIFT City is a very attractive place where exporters can hold their receivables and also raise trade finance for their exports and imports. In addition to that, I think we also have the availability of the tax benefits here. Enable the banks here and the factoring companies to offer trade finance at a more attractive rate than they would obtain in a global destination.
So talking about IBUs, so you did mention a lot of the banking activities that they sort of carry out, including, borrowing through ECBs, trade finance, currency swaps, interest rate swaps. But the remit that these IBUs have in GIFT City goes way, way beyond it. And you did mention it, earlier, like they can do, for example, invest in, public markets as an FPI. They can distribute capital market products. They can operate as an investment banker. They can act as a custodian, you had mentioned. So this remit is huge. So how do you, from a regulations perspective, ensure that there is no conflict of interest?
So, let me put it this way. This is the activities that you mentioned are not what the banks are not doing in other jurisdictions. The banks are already, providing these kinds of services in all the global jurisdictions. So, our advantage is that being a unified regulator, it enables us to do that in a very coordinated fashion.
Correct.
Because otherwise, I think the bank would have to go to multiple jurisdictions and
regulators and get permits.
Yes, but to answer your question on conflict of interest, the rules and regulations that a bank has to comply with before obtaining any of these additional registrations is the same for everybody. Whether it is let's say, take the case of a custodian license. So the custodianship license will require the bank to comply with the regulations as much as would any other entity which would want to apply for that license.
Okay.
So from that perspective, I think there is no special treatment afforded to the banks for any of these extra additional services that they may render by procuring an additional registration or an authorization.
Okay.
So not only that, let me also add that banks, being highly regulated entities, are likely to be more compliant than in most of the other entities, because they have a reputation to keep, and they have very strong regulations both in their home country as well as in global jurisdictions. From all those perspectives, we believe that banks can play a very important role in intermediation of a number of capital market and insurance products. Because let's assume that a customer, an NRI who sits in Dubai, is investing in a dollar structured product as a deposit in a GIFT City bank, then he might also want to buy an insurance product. He may want to buy invest into an investment product or a mutual fund or some such thing.
Correct.
So I think the bank being able to offer this in a regulated manner actually solves the customer problem in a significant way. So the only thing is that the regulatory mandate extends to the fact that I think there cannot be any mis-selling or wrong selling to customers who are not capable of actually understanding a particular product.
Okay.
And we believe that an institution like a bank is more likely to be compliant than any other kind of institution. So from that, I think we see a very low risk in this their participation in these activities.
So, Mr. Rajaraman, you had mentioned that the fund management entities have really scaled up their business in GIFT City. But from a regulator's perspective, you have adopted a risk-based approach to regulation as opposed to a rule-based approach. So I just wanted to understand that from a financial jurisdiction like an international financial jurisdiction like IFSCA, how does a risk-based sort of approach sort of trump over a rule-based approach?
So I would like to say that world over, all regulators have switched to a risk-based approach,
right?
Because what happens in regulation is that every regulation comes with a certain cost,
right?
And we always believe that regulation has to be proportional, and it has to be proportional to the size of the entity, the risk that the activity carries,
correct,
and so on and so forth. So from that perspective, I think world over, I think most regulators are now moving towards a risk-based system,
right?
Risk-based supervision, risk-based.
And you had the luxury of adopting it because you're
more aligned,
you're new to the
yes, and more aligned to international. So we have learned from many of the international jurisdictions which have gone ahead and adopted risk-based approach.
Right.
So I will say that like for instance, let us take the case of a fund industry.
Right.
So in the fund industry, the market can be segmented into sophisticated investors, typically institutional investors,
correct,
and then other kinds of investors which are probably high net worth individuals, etc., etc. And then come the retail investors. So I think there is a pecking order in this whole thing. So what applies to a sophisticated institutional investor or a sophisticated HNI client may not really apply to a retail client. I think a retail client, a retail customer has to be guarded. He has to be protected. So because obviously, they are less informed, less capable of being informed, and so on and so forth. So from that perspective, I think even if you look at our fund management regulations, we have actually a gradation. So we have an authorized FME, which actually looks at a fund manager who looks at pulling in money from sophisticated investors.
Right.
There, I think we have given the limit of, say, the investment should be at least $250,000.
Correct.
To ensure that I think the large investors who are well informed and capable of protecting themselves are part of that pooling vehicle. Similarly, if you look at it, we also have something called a registered FME, which is non-retail. So there, I think we have provided a minimum limit of about $150,000.
Correct.
So these are also, as I mentioned, maybe persons who are high net worth individuals or wealthy people, I think, who are capable of because this sum of money cannot be mobilized by an ordinary individual.
Correct.
So therefore, I think the eligibility requirements are a little more tougher than the VC. But then I think it is fairly light touch, to the extent that I think these individuals are sophisticated investors. Then comes the registered FME, which is retail.
Right, the retail.
So retail investors. So these investors require protection, and they require to be, I think there has to be a strong guardrails as to, how the product is sold to them. What kind of information should be told to them, and what
kind of product can be sold to them.
Absolutely. And what kind of disclosure should be made regularly to them, and so on and so forth. So, and the means of communication, because some of them, in the retail segment may also, especially in a domestic market like India, I think may not understand the English language.
Correct.
So you may have to have communications in vernacular, in simpler language, non-technical language, and so on and so forth. So therefore, from all this perspective, the FME retail regulations are impose a higher burden of compliance, and we have ensured that the fund manager is put to a higher scale of level of test in terms of his capabilities, net worth, and so on and so forth. So that I think a fund manager who has got a proven expertise and the capability, demonstrated capability, comes into this segment. So from that perspective, I think we have always believed that proportionality in our regulations, in the manner that I explained, is very important part of our regulatory framework. The risk-based approach is not only restricted to regulation, but also to supervision. No, because as a smaller as a regulator, I think one always runs into the issue of the ability to supervise every entity that you license. So therefore, from that perspective, I think our supervisory teams also have developed a risk-based supervision framework where they based on certain KPIs, they heat map the entities, and then they look at entities which are classify them into high risk, moderate risk, low risk, etc. And then accordingly, supervision is focused on the high risk entities,
right,
because with a greater frequency. So from that perspective, I think the risk-based approach is I would say it's a tested approach, and it is also a very a practical approach to solving the day-to-day problem of regulation and supervision.
Right. So, talking about the fund management regulations, in 2025, you have sort of gone in for an overhaul of the regulations. And I think you were specifically looking to design it in a way that you make the GIFT City IFSC sort of more sort of attractive than, jurisdictions like Singapore and Mauritius. So how have these changes actually lowered the entry barriers for new fund managers, or made it more attractive for family offices or HNIs to, invest through IFSC?
So, if you look at a global fund industry, I think the nature of the fund industry is very diverse. I think on one side you have very sophisticated institutions like pension funds,
right,
sovereign wealth funds, etc. In the middle stand, I think, institutional investors, and then on the other hand, I think you have other kinds of investors which include individuals and maybe families, and so on and so forth, and so on and so forth. So from that perspective, I think the regulation also has to be sensitive to these categories of people. So our regulations have a separate, slightly differential treatment for family offices, for sovereign wealth funds, etc., which are capable of managing themselves. Similarly, I think for sophisticated investors as well, I think we have special provisions which enable them to actually to be managed. I think with a lighter touch approach. So,
how do we compare with jurisdictions like, say, Singapore and Mauritius?
Yes. So, I would rather say that I think as I already mentioned, the way in which we made the regulations, I have ensured that I think we look at certain parameters, like for instance, the minimum corpus that is required, the eligibility criteria in terms of net worth, the number of investors he has to have in a fund.
Right.
So these are all factors which are determined by the investor class, as I already mentioned, I think. So, and the investor class and the type of the category in which he comes, I think. So, therefore, from all that perspective, we have actually ensured that the limits that we have set, either the floor limit or the upper limit, as in many of these KPIs, are benchmarked to the practices which are followed in the rest of the world. So we have been constantly, when these numbers are also moving, in fact, the global market is also constantly evolving.
Right.
From that perspective, our regulations we have a regulation on making regulations.
Okay.
So which ensure that every 5 years we review or
revisit those
regulations after benchmarking ourselves with the rest of the world.
Right.
So we evaluate what is the performance of the regulation in terms of delivering the kind of intended market outcomes. In addition to that, we also look at how have the global regulations evolved in the meantime.
Correct.
So using all that as the basis, I think the new set of regulations or the modified regulations are drafted. So let me give one or two examples of this. So taking into account that there are a class of investors called sophisticated investors.
Correct.
So we have introduced an accredited investor framework to enable such kind of investors to be easily be onboarded by the fund managers.
Right.
So we have defined what is an accredited investor and how they may be onboarded, and we have delegated the powers to the fund managers. We do not take part in, and we supervise whether these in compliance of these regulations. Right. Similarly, I think we have seen that there are certain class of funds or investors which do not want which want the management of the fund to be outsourced to a third party. So typically, we would say fund managers who want to manage smaller fund sizes. So they are not, they do not want to meet the costs of running a full-fledged fund manager.
Right.
So which means that therefore for such kind of fund managers, we have introduced a new regulation called third-party fund management services.
I saw.
So funds which are size below $50 million, typically small angel funds, venture capital funds.
Correct.
They can entrust the work of managing the fund to a third party. Nothing. So this also is probably
a very elegant structure actually for small funds.
Absolutely. And similarly, I think we also are concerned with the fact that I think one of the important the goals of IFSC is to enable that the Indian diaspora who sit across the world. Many of them are very wealthy individuals who have India's interest at heart. So last year, for instance, non-resident Indians remitted home $139 billion. This money was converted into rupee, used for consumption and also investment within the country. So we believe that similar sums of money are invested by them in global stock markets.
Right.
So GIFT City has got the opportunity of hosting these investments and actually
be a conduit for this.
Absolutely. Enable them to manage the global investments out of GIFT City.
Correct.
So because here there is no restriction on investing abroad, and we have an attractive tax regime.
Right.
So far I would say that nearly about more than 100,000 NRI investors have been onboarded by some of our capital market entities.
Right.
If you look at the banks, I think more than 15,000 NRIs have actually have deposited money with the GIFT City banks, and the amount is more than a couple of $1 billion.
Right.
So we believe that this is just the beginning, because if you look at the numbers which I just mentioned, I think this is just the beginning. So therefore, from that perspective, creating attractive regulations for NRIs to come in is very, very important. So with the help of SEBI, we launched a framework called an NRI fund framework, where 100% of the investments could come from NRIs.
Okay.
So yes, so this framework is very attractive from the point of view of attracting NRIs to pool money to invest into the Indian capital markets.
So two more things I wanted to talk about. One was I wanted to talk about bullion, and the other I wanted to talk about aircraft and ship leasing. So you've also sort of revamped your IFSCA bullion market regulations in 2025. So how has that sort of democratized the import regime? And, how has it been helpful for gold importers to save on transaction costs? And, how has it resulted in price discovery? Because typically price discovery used to be based on global gold exchange prices.
So the bullion market, as you rightly said, has been traditionally working through the OTC market.
Correct.
Where the deals are between two individuals.
Right.
So there have been very rare instances across the world where when gold trading has moved to the exchange, I think, with the exception of a few jurisdictions. So from that perspective, I think the IFSCA's attempt to actually to attract a significant part of the gold trading into the exchange traded mechanism,
right,
is very remarkable.
Right.
Because the focus is that in India, I think the most important, one of the important things that we need to do is to actually to bring more transparency in the markets.
Correct.
So especially in the bullion markets. So the exchange traded platform, which is run by the IIBX, which is an exchange licensed by IFSCA,
right,
in GIFT City, is a very important player in this exchange traded mechanism for gold trading import.
Right.
So in the last 1.5 to 2 years, they have actually managed to import about 100 tons of gold through the exchange, physical. This is not it's not on paper, it's physical.
Okay.
And about 1,146 tons of silver.
Right.
So we believe that that while this wholesale exchange traded mechanism is a very important thing, we believe that this market will now stabilize and then will grow over a period of time as the India, UAE, SEPA, and other kinds of mechanisms actually help in actually to bring gold in a very organized, bullion in an organized fashion.
Right.
We also believe there is an investment opportunity here. World over, investors also look at investing in commodities,
Right.
in precious metals and other things, in addition to market securities. So the Bullion Exchange is also working on retail products for the NRIs and others around bullion, so which will enable them to invest in such kind of products. So we believe that the market will soon evolve and also have a strong retail market segment as well.
So, in coming to the aircraft and ship leasing sort of framework that IFSCA has set up, previously a lot of, you had mentioned right at the beginning that a lot of this, all these billions of dollars of lease renters, etc., were flowing through markets like Ireland and, all those kind of markets. So, how have, the enablements that you brought about through these, the IFSCA framework, how has that helped sort of incentivize India's Make in India initiatives in this particular space?
So, as I just mentioned in the beginning of our conversation, a lot of the Indian businesses have set up leasing entities across the world.
Correct.
For both ships as well as aircraft.
Right.
So, more than in the meanwhile, we are seeing very rapid growth of the aviation and shipping markets within India.
Right.
So, we here sense an opportunity to actually host a lot of these leasing and owning activities out of GIFT City.
Right.
So, because we have an attractive tax ecosystem, we have enabling regulations through our ship leasing and aircraft leasing frameworks. So, we launched this about 3 years ago, and as a consequence, I think we are now seeing very active interest amongst both the Indian airlines for leasing their aircrafts as well as Indian shipping companies to lease ships out of GIFT City.
Right.
So, if you look at the airline industry, I think there are more than 38 aircraft lessors who are registered here. The Air India, Indigo, I think, and all the other airlines have actually registered. In addition to that, we have a few entities which are in the nature of OEMs. Like for instance, Rolls-Royce, Willis, and there are many other companies which have actually registered their leasing entities here, which means that they have, like for instance, Willis and Rolls-Royce actually lease jet engines to the airlines through their entities in GIFT City. So, as of now, nearly about 384 assets, aircraft assets, which include nearly about 173 aircraft, mid-size and large aircraft, and engines and other very large equipment, which are meant for the airline industry, which is currently leased out of this place. Similarly, if you look at it, 6 banks here. So, we are focused on not only enabling the leasing, but also supporting the financing of this. Currently, financing of aircraft or ships largely takes place overseas in many of the global financial centers. Indian companies go there to raise finance. Now, we have brought these markets here. Banks like Qatar National Bank, Standard Chartered, Axis, DBS, etc. They have started financing of aircrafts out of this place, MUFG, etc., etc. So, similarly, I think, the total aggregate credit extended by the IBUs here have crossed $317 million at this point of time. And this is bound to scale up as the...
And India is one of the biggest aviation hubs, growing
absolutely
big time in aviation.
Just to add up a thought to your point, between up to 2043, Indian Airlines are expected to place orders for nearly about 3,300 aircraft.
And hopefully all of that will go through GIFT City.
And as of now, I think at least 2,000 aircrafts have already been ordered.
Okay.
So, which means that on an annual basis, at least about 200 aircraft will get delivered.
Right.
So, and as you rightly said, a lot of that would happen through GIFT City. Similarly, in the case of ship leasing also, I think we have now more 36 ship leasing entities registered here, 34 vessels, very large vessels, large crude carriers, gas carriers, ethane carriers who have been registered out of in these entities here. So, and financing of these entities also have happened. I think today, I think nearly about $71 million of bank financing of these ship lease lessors has happened. I think. So, we expect that this also to scale up for one simple reason. The Honorable Prime Minister of India in September, as part of the certain very crucial reforms announced a ship building initiative in India. 73,000 crores of incentives have actually been announced.
Right.
So, now a lot of ship leasing would happen out of India, building would happen out of India.
Right.
In fact,
that's where that Atmanirbhar Bharat sort of mission also gets
absolutely. So, one of the entities have actually set up an arm here to a leasing entity here, which has actually will be placing orders and buying the ships which are built in India,
Right.
and then leasing it out outside. So therefore, a lot of these shipbuilding activities also would get financed out of GIFT City as well. So there is an opportunity for us to support and assist in the shipbuilding mission, which has been announced by the Government of India.
So I had a question because on this TechFin and Ancillary Services Regulation 2025, which IFSCA came out with,
Yes.
which is a consolidated regulation, where both TechFin and support services have been covered. And I think this is basically an enabler that you have done to ensure that global capacity centers can sort of, grow in India. So could you just tell us a little bit about that? Because it's a very intriguing kind of regulation where you've sort of combined two things together.
So, in any financial center, there are two categories of service providers. One is the core financial service providers. That is the banks, the funds, the stock exchanges, the insurance companies, etc. And then you have the support service providers.
Correct.
So, which we call as ancillary services. These typically are brokers. They could be trustee companies.
Correct.
They could be fund administrators.
Correct.
They could be legal services firms.
Correct.
They could be advisory firm, management consulting firms.
Correct.
So all these firms have provided all the support services for this core. They work around the core sector.
The financial ecosystem.
Absolutely.
Right.
So they also intermediate between the businesses and the core financial companies.
Yes.
So therefore, from all these perspectives, a very sound and complete ancillary services ecosystem is absolutely very important.
Right.
So therefore, from that perspective, the upgrading these regulations to ensure that we cover the whole host of service providers. Like for instance, let me give an example. If you take the case of any asset management firm, whether it is a ship lessor or an aircraft lessor,
right,
or a financial securities asset management company.
Correct.
One of the very important elements of all this is the valuation.
Right.
So the valuation of assets is very, very important from a market regulation perspective. So valuers are also important. So I'm just giving an example of how each of them add value to the ecosystem.
Correct.
So the regulation that you mentioned, the TechFin and ancillary service regulations, provide for setting up of nearly 27 ancillary services, 27 kinds of ancillary services, and 23 kinds of technology services.
Okay.
So coming to technology, let me say today technology has become so embedded in financial services that they are two sides of the same coin. So one cannot separate technology from UPI.
Right.
And because though if you may look at it from just as a transfer of money, but it is actually a highly technology intensive activity. So from that perspective, we believe that every dimension of financial services will today be dominated by technology.
Right.
So from that perspective, building a strong technology ecosystem here comprising of core technology companies is also important. So the TechFin part of this regulation aims to attract them. The government of Gujarat has also announced a very strong set of incentives for TechFin companies. Okay. So under their ITITS policy, there's things like employment incentives, capital subsidies, and so on and so forth. So today we have the likes of Cognizant, TCS, Infosys, Exaware, have launched their offices here. So these will develop technology for banks, insurance companies, and other corporate businesses in IFSC and other places. So we believe that the time has come to actually to globally export the services to the rest of the world. And you may all be aware that India is the GCC capital of the world.
Right.
India houses nearly about 2,000 GCCs for all the world multinational companies.
Correct.
And they employ nearly about 2 million people, and they are present in all kinds of sectors, starting from semiconductor firms right down to accounting firms, financial sector firms, down
right.
to BPOs and KPOs, etc., etc. So GIFT City also has the same opportunity of hosting them. We also have a slightly different category called the global in-house centers.
Okay.
There are many large financial sector companies like banks and insurance companies which have a back office, a middle office,
right.
which is located in India. So GIFT City also offers a GIC framework which enables such BFSI sector entities like a bank or insurance companies to host their capability centers for technology development or back office or middle office operations within the city. For example, the Bank of America, which is in the same building as we sit now,
right.
has nearly about 2,500 people involved in the development of code. It's basically software for their international operations.
Right. So taking over from technology, I had one last question, sir, for
yes.
you. And that is GIFT City IFSC is now pioneering the development of regulated platforms for tokenization, of real world assets, tokenization of say real estate, etc. So what will be the legal and operational framework for this? Because I think tokenization is going to be something which is futuristic, but it could be very, very big.
So, I mean, tokenization, like other forms of technology, is a very rare need.
It's nascent
new and nascent, as you rightly said.
Correct.
So, there are world over experiments which have been done in tokenizing payments, tokenizing assets like financial securities like funds,
Right.
Financial securities like bonds,
Right.
and so on and so forth. Tokenizing things like real estate,
Right.
real world assets like ships,
Right.
aircrafts, and so on and so forth.
Right.
So, the opportunities are many. If I may say, tokenization is nothing but a digital representation of the value, on the underlying value in any particular asset.
Correct.
So, while as a regulator, I think we have to be very cautious about how the technology would impact all the stakeholders, the market, the customers, the investors, and so on and so forth.
Right.
So, from that perspective, I think we therefore thought it fit that we must, based on all these experiments,
Right.
draft a consultation paper on how regulation should evolve. And therefore, we issued a consultation paper a few months ago. And we have received a large number of comments. And these comments are in the process of being examined. Now our team is working on on a regulation that could work. So legal examination of tokens. And
so you will be one of the first few regulated platforms available anywhere in the world for tokenized assets.
That's right. No, I mean, I would say that there are a few countries which have already ventured out.
Okay.
But while we do that, I think we must be ensure that we are on a very sound legal footing.
Right.
Therefore, after the legal examination is concerned, I think we would also be probably, if require any amendments to any laws or something, we would be approaching the government of India for consideration.
Right.
So while that be so, I think we also have allowed a few players to enter our sandbox.
Right.
Because the sandbox also educates us and as a regulator and how the tokenization would function, when it comes to the real world.
Right.
So therefore, from that perspective, that when one of the entities is actually doing a tokenization of real world of the units of a fund which has invested into real estate.
Right.
So I mean, there are a few more applications on tokenization which we are in the process of considering. So these, I would say that it's a very it's a new area, and I think we expect over the next several months we will come out with some steps to put this on some regulatory footing in consultation with the Government of India.
Thank you so much, Mr. Rajaraman. This was indeed a very fascinating and educative discussion.
Thank you very much, Mr. Krishnan. I think I really enjoyed talking to you. Look forward to much more active collaboration with NISM.